Okay, there we go. So should be able to see me now. I was trying to tally up all my totals for a certain program, but it's okay. I can just show raw data anyway. So welcome everyone to Trading Coaches Playbook. My name is Brandon Wendell. I'll be your host for about the next hour or so. And as my dogs get comfortable in the sunlight behind me here somewhere on the ground. Um, yeah, so welcome everyone. Just a quick reminder though, as we get started, we may look at the markets, but we're doing this from an educational standpoint. I'm not a broker dealer or investment advisor. Matter of fact, we're education. We are not licensed. So anytime we look at the markets, we're not giving any recommendations. We're just simply making observations and giving our opinions about those markets. And we're not telling you to buy, sell, or hold anything in particular, giving personalized recommendations. All markets do involve the risk of loss. Let's see, what's that? Okay. And all we can do is try to minimize the risk. And that's actually part of what we're going to talk about today. Our subject for today is a little bit about zero DTE options and how to deal with the risk in those particular options. And obviously, there's a lot of different programs available. There's some premium online workshops, a lot of free workshops. Every Friday, we do the Trading Coaches Playbook. I'm actually going to be talking about futures next week on the 13th, so you can catch me there. And one of the things that I'm very active in, and I'm going to be talking about, is zero DTE options. I run a program, and welcome, Kevin. Good morning, good afternoon. Just saw you yesterday, Brenda. Everyone, actually, welcome back. But you can see there's a program that I run for Wealth Builders HQ called SPX Cashflow Secrets. And I've been doing that program now for multiple years. I can't remember when I first started it, actually. And, I'd love to have you join me if you're interested in that program. Basically, it's multiple phases and multiple pieces. What happens is every day, well, before I get there, sorry, there's educational videos which are talking about how to do what's called zero DTE well, I call it SPX Cashflow Secrets. And that's what it is. It's a way of potentially generating income or cash flow by using zero DTE options. And if you're not familiar with zero DTE options and what they are, see, I think I'm logged in on Options AI. I mean, there's tons of different platforms you can trade on, and I happen to be logged into a demo account here. So a zero DTE option is nothing more than trading an option that expires on that day. So if I look, for instance, at the SPX, we have options expire today, November 8th, Monday, Tuesday, Wednesday, Thursday, Friday next week, Monday the following week, and so on, going all the way out for almost a year. And basically, all those options, it doesn't matter if they're dailies or weeklies, which is weird because these ones that expire every day, they're actually called weekly options. Even though they expire every single day, they're still called weeklies because originally they were created to expire every week rather than the standard, which is monthly expiration. If I go out to see, is it open right now? No. Actually, I'll go Trade Station. We're doing a lot of options work with them as well. And actually, yeah, my stuff works with Thinkorswim. Absolutely. As a matter of fact, that's what I use on a regular basis. I don't know if you saw it right there is my toss. I could open that one too. But first, oh, did I do live? Yeah, it doesn't matter. I went to go into simulated mode because I wasn't, if I end up placing trades, it's a little early for me to do my strategy right now, but that's okay. But yeah, it also works on toss. And where is my toss now? I got too many things opening here. Let me close a few things out. And basically, where did I put it now? Ah, well, anyway, there's education and there's also documentation that supports the education. Then what happens is every day at roughly 2 o'clock in the afternoon, I send out SMS text messages. I'm going to go over that with you as well. But what I do is I send out information about what's happening with the markets and then a couple of possible trade ideas. And I track all the results as well. Oh, I got to update these. It's not updated since June. I actually do have the updates. If I take a look at September, and we'll talk about how this works and what they are in a moment. But you can see that I had a win rate 94.74%. pretty good. The average entry time, though, for my trades was 2:08 in the afternoon and exiting at 4 p.m. when they expire. So I'm in trades for less than 2 hours. And it's about managing risk. That was September. October was not as good, but still decent. Let's see, here it is. There's October. And again, well, actually entered a little bit later in the day, had an 81% win rate roughly. So it didn't make quite as much, but still did okay. And where is my toss? I just opened that up, didn't I? There we go. There we go. Go paper money. But yeah, all this, I mean, everything works with whatever platform you wish to trade on. It really doesn't matter. Trading is trading. And my thing is, I'm all about education, identifying high probability opportunities. So I had, let's see, minimize that for now. Just got too much stuff. Like I said, I can always bring it back if I need it. And actually, I'm going to close a few more things. Too many windows. There we go. Anywho, I'll leave that open. Okay. Like I said, with the E-mini think tank, it's pretty active. Every single day, I send out an SMS text message. There's free education beforehand, so you can learn what the strategies are, how they work, when to cancel trades, when to put them in. All that information is there. And there's some bonus videos. We get together for Q&A sessions on a regular basis. And we talk about, what works, what's not working, how to help you learn these strategies better. And where was I here? Yep. If I go to trade on TOS, all products, basically I can trade 0 DTE on anything you want. It doesn't have to be the index. You can see Apple, there's 0 DTE right there. Anything that has an expiration on the same day that you are trading is 0 DTE, period. So every single option, whether it's a weekly, quarterly, monthly, end of month, end of quarter, they will all become 0 DTE on the expiration day. They all do, no matter what. So, the ones I typically trade, though, as I said before, is the index SPX. And there's some real advantages as to why I do that. I'm going to talk about those. So, where am I going here? Got too much open. Let's just go there. So basically, like I said, I run a few programs here, but the one I'm going to be talking mostly about is SPX Cashflow Secrets because it deals with those 0 DTE options. And I went out to the CBOE website today and grabbed some data there. And you can see that, unfortunately, they haven't updated since 2023. Most of the reports are a little lagging there, but that's okay. And basically what's happening is 0 DTE options started off relatively small in comparison to the rest of the market for options. It's that blue at the bottom there, that lighter blue. And you can see what's happened. And actually nowadays, if you were to go out, over 50% of the volume on the S&P 500 is actually 0 DTE. So that's pretty crazy. That's gained that much popularity that quickly because they've only started these really, I guess 2016 is where they really started gaining a little bit of popularity. I forget when they started the weekly options because that's what 0 DTE kind of started. I think it was in 2015. So yeah, in a short period of time, 8 years, it's gone to a majority of the trading that's going on in the index. But what we have to understand is that when you're trading smaller time frame options, the Greeks, which are the risk parameters, they affect the pricing differently. So again, yeah, it is a lot of volume. So right here, if I go into my option chain, for instance, and I'll just put in single for options right now, we've got Delta, Gamma, Theta, and Vega, some of the major Greeks. There's Rho, but we don't really look at that too often. But these Greeks affect options that are expiring quicker in different ways than ones that don't expire until further out. If I go out, you can see we got quarterlies, weeklies. Be careful with these AM options. If you're not familiar, there are options that say AM. You'll notice that sometimes, let's see if I go back to the earlier ones. There it is. Notice there's one on November 14th, November 15th, November 15th. And it says 6 days, 6 days, 7 days. Wait a minute. November 15th, is it 6 days or 7 days? Well, yes, it is. Okay, so what happens is these particular index options expire at 4 p.m. on that date that's stated. So for instance, this option, 15 November 2024, expires at 4 p.m. on the 15th. Okay. However, this option is an AM expiration. Technically, you cannot trade this after 4 p.m. on the 14th. So that's why it's saying 6 days. Notice it's the same as the 14th because that's the last day you can trade it. It says last day until trading day. This date is the settlement date. So what happens is the market closes at 4 p.m. on the 14th and you're done trading. Wherever you are, you are. So if you have an open position, it could be a winner right now, it could be a loser. It doesn't matter. The settlement price will be the very first trade that occurs the next morning at 9:30 in the morning. The very first trade that occurs, that's the settlement price. So you can go to bed a winner, wake up a loser. That's not good. Or vice versa. Maybe you go to bed a loser, wake up a winner because you had a gap in price. That'd be nice. But unfortunately, that's not the world we typically live in, right? It usually goes the wrong way instead of the right. I try to avoid AM settled options like the plague. Okay. I want to know when the market is closing and I cannot trade it anymore. Did I win? Did I lose? Done. Okay. There's nothing you could do about it until the next morning, except for worry about it. Stay up all night wondering. And it's not tradable. So it's kind of crazy. But make sure you trade the right series. And we got to understand basically what happens with these Greeks, delta, gamma, theta, and vega, those are risk parameters for options. And that's what it's all about, is protecting our risk in the markets. You cannot control, and I've said this before, you cannot control whether you're going to win or lose in the markets. Period. You can't control it. The only thing within your control is how much you're going to lose if you're wrong. So we can try to control the risk. So let's see, I actually opened up my trade station as well. I can open up an Option Station Pro. Actually, I don't have too many platforms open. I was just pointing out that you can use whatever platform you want. It really doesn't matter. And actually, yeah, it doesn't matter. I don't know that much in this account. I'm just playing around with this one. Let me close it out actually, because it will slow down my computer. This is a bandwidth hog. So I'll stick with the toss for right now. Like I said, you can trade on anything you want. It doesn't matter. I don't care. As long as you're comfortable with the brokerage and you get decent pricing. So anyway, what I was saying is that these risk parameters change depending on the expiration of the option. Here I have 0 DTE. These expire this afternoon at 4 p.m. But if I go out a little bit here, let's say we just go 30 days out roughly, December 9th, you'll see that the Greeks will be different and affect the pricing differently. Okay. So for instance, we have delta, that is directional risk. That's going to be pretty standard, although I'll show you how it changes a little bit. Let's take the at the money option. Right now, we're trading at 59.91, right? Well, 59.90 is the closest, we'll call it at the money option. That call right now has a delta of 0.54, and we have a negative 0.45 for the put. Okay, well, if we go out a little further here, no, I think the market's open on Monday. I'm not sure. I got to check, but I don't believe it's closed. That's a good question. I know I'll be getting all my free meals because Veterans Day, right? Why not? I'm a disabled veteran, so I get it. But let me see. CME holiday. I don't think that is one of the holidays, though. Oh, thank you. Yeah, I thought the market's open. Trip is saying that it's open. I'm pretty sure it was. I didn't think, yeah, the next one isn't until Thanksgiving. So no, it's a holiday. It's not a holiday, except I get my free meals. Anyway, so and thank you for your support. People were saying thank you for your service. Anyway, it was a long time ago. It was first Gulf War. So the markets are open, but the post office and the banks are closed. Yeah, that's what I thought. All righty. Anyway, like I was saying, we can see that on the December option at the money, which was the 59.90, Well, the delta is pretty similar, isn't it? Negative 43 instead of negative 45, I'm sorry, 57 instead of 54. So it's pretty close, right? But what will definitely be different will be theta, time decay, and vega, volatility exposure. So let's kind of take a look and see, how do the zero DTE options get affected by, or the Greeks, excuse me, get affected by these zero DTE options or time in general? Okay. So one of the things that we're seeing is the delta. And what happens is the closer to expiration, in the money options move faster towards 100, meaning they're going to react and change price much faster and bigger. They're going to act more like the underlying stock. Deeper out of the money options will move further away from zero. I'm sorry, they'll move more towards zero delta, meaning they will not respond at all to changes in price. So if you're deep in the money, you could have some big changes either in a profit or a negative as you get closer to zero DTE. So that's one thing you have to be aware of. You can see that this is a chart of delta, and it's based on the time left. Zero DTE is that white. It's pretty much vertical, meaning that if you are close to being at the money, this is showing the underlying price right here at about 54.60 something. And the closer you are to at the money, the closer you are to 100 and acting just like the stock. The further you go out in time till expiration, this was 30 days out. And you can see how it's flatter, which means that we're not responding as quickly, typically. So at the money options will go closer to acting like the stock the closer you get to expiration. And just an example here. This was just showing a while ago. We had a delta of 47.71, and I didn't change anything with the price. This is the same call, 50-10 call each time. The only thing that changed is time till expiration. And look at what happened with the delta. It kept growing. Now it dropped off a little bit on the day of expiration, but for the most part, that same strike price, same underlying price changed delta. Isn't that crazy? So you got to be careful with your pricing that you select. You got to worry about the underlying the underlying price and the strike price a little bit more. What else do we have to worry about? Well, again, zero DT options premiums have huge price swings for the premiums based on small changes in the underlying security. And that's not as big when you're dealing with long-term trading. So if you got an option that doesn't expire for 90 days, 6 months, you don't have to worry about delta as much. So, and you can adapt the delta as you get closer. With zero DTE, you got to be a little more precise with your pricing. Another time impact is gamma. Gamma is the rate of acceleration of delta. And obviously that's going to be very big as well. It's the highest at the short term and at the money options. So this is showing you that when you have, well, zero DTE was gamma was flat, but you can see that 30 days out, gamma is not affecting you as much. Basically, the way you look at gamma is the pressure you're putting on a pedal in your car, the gas pedal. It's how much you push it down. And of course, the faster you push it down, the harder you push it down, the faster your car moves. That movement of the car is delta. So gamma is the pressure from your foot, your right foot on the gas. And it's very impactful when you have very little time left till expiration. So you have to be careful with that gamma. Again, same option. This happens to be a GE 160 call, and gamma was at 3.38. Dropped a little bit, but the closer we got to expiration, the higher gamma went. And it became a much bigger influence. So once again, between gamma and delta, price changes of the underlying security give you a much bigger impact on your options premium. So a small change in price can be a big reaction and either give you a good reward or cut your profits or increase your risk dramatically. So you got to be careful of that. So we have increased gamma on zero DTE. Another one we have to worry about, maybe not, is volatility. So volatility is relative to time. Longer term options have more volatility exposure. So while we do have to worry about the pricing, what we don't have to worry about is volatility. Now, volatility as a whole will impact the kind of premiums that are out there. Higher volatility gives you higher premium, low volatility, lower premiums typically. So when we're selling options, we would usually like to see high volatility. But the nice thing is, once we figure out if volatility is high or low, we don't have to be as reactive to volatility changes throughout the day, because they're on zero DTE options. The volatility changes will not affect those options as much as they would a longer term option play. So you really need to guess correctly on both the current level of volatility and the impact that it might have in the future when you're trading long-term options. So if you're trading an option that expires, 5-6 months from now, you better be right that you bought low volatility or sold very high volatility and it's going in the right direction. With zero DTE, we don't have to worry about it. It's a very minimal impact to our option pricing. And you can see that here as well. You can see that zero DTE, look what happened to the Vega. It went down to almost nothing. We started off at 18 and just dropped. Yeah, it went back up to 13 for a little bit, but overall, we were way down at 2. We had very small impact from volatility on our option pricing at zero DTE. So we worry about price. We don't have to worry about volatility as much. What about time? Time's kind of tricky. Okay. Time decay is how much the value of the options drop for every day that passes. Well, obviously, if you have zero DTE, they're expiring that day, right? So we don't have to worry about the end of the day because it's going to go to zero anyway. But we do want to time our entries properly. And that's something that a lot of people have kind of argued about and experimented with. And my SPX trade strategy, I already mentioned to you, I try to enter relatively late in the day. My average entry time, 2:11 in the afternoon. I'm only in the trade for less than 2 hours. Why? Well, time is money. Time is risk. You can see that if you have a lot of time left until expiration, typically the time value doesn't decay quickly, but it does decay very quickly when you have very little time left. Well, let's take a look if we can break it down. I'm not going to worry too much about long-term like this because it really doesn't matter as much for us. Let's worry about intraday. Now, first of all, I want to explain why I trade what I trade. I mentioned that when you trade zero DTE, let me go back to, there it is. And we can go to Tesla. Do we trade zero DTE on Tesla? Absolutely. There's an option that expires today. There's an option that expires next Friday and the Friday after that. You can trade zero DTE on any option that's expiring that day, right? Once again, the deltas, they're going to be very, very sensitive, as well as the gamma. If I go out further, right here, let's go out 42 days now. We can see those both. We're currently trading around 317. So right here, 317 and a half option. Oops, delete. And where is it here? Actually, we got 315s on the other longer term. So we'll use 315 instead. There we go. 315 and 315. There we are. And basically, what I just want to do some comparisons. If we're looking at 315 on a zero DTE, delta 65. Look at the delta here on the long term, 57. Why? It's in the money, and you'll move closer to 100 or 0.1 or 1.0. You can see the gamma, 0.06. Here, it's only 0.01. Why? We have more sensitivity to changes in price because there's less time left until expiration. But what we don't have to worry about is vega or volatility. We only lose or gain 2 cents for every 1% in volatility change. It's much different than 42 cents, isn't it? And time decay, though, whoa, look at that, $1.50. Well, because we're expiring today versus 32 cents. Okay, now you could trade stocks and zero DTE on stocks. You could trade SPY. But I don't like to. 2 reasons. Okay, one, costs. Fees are a little bit higher, and that's actually what I'm showing right here. This is from the CBOE, and they show you on the S&P 500 index, regulatory clearing fees, exchange pass-through fees, brokerage fees. Look how small that is on average. This is going on a different study. I don't know which brokers they selected, but they went out on the CBOE exchange and they took a look to see, what's it going to cost you to trade? The SPX was very, very cheap. Almost 1/5 the cost of trading the ETF or trading some of the E-mini futures from the CME. There's options on futures as well. I talk a lot about that. Actually, I did last night in one of my programs. So for one, I don't know about you, but I like to trade, but I don't like to spend a lot on fees. Okay, so can reduce the cost by trading the index. That's a nice bonus. The other thing is the settlement. I like to sell options, and when you think about it, it's pretty neat. The reason why, yeah, I like cheaper. Exactly. It's called being frugal, right? We're not being cheap, we're being frugal. So, where is I going with this? Here we go. I was going to go over to my SPX chart right here because this is what I use every day. The other thing is, in what we're trading, one of the reasons why I use the SPX is, let's say you sold a put right below this demand zone. Okay. Now, actually, before I delete that, let me just check something here. Yeah, we're not getting up there. Anyway, let's say you sell a put underneath this demand zone. And we'll say you sold the 59.45 put. Okay. What does that mean? That means that you are obligated to buy at 59.45 because you sold a put. It can be put to you, right? Well, if we were to do this with a stock, or actually the ETF, let me go SPY, the ETF. Oops, wrong button right there. And I think it was about the same area. Actually, where was that one? I forgot. That was stupid. Oh, well, I'll just make it here. It's 59.45. So if I sold a put, again, under this level, 595. Okay, let's say I sold the 595 puts. That means I am obligated to buy 100 shares of SPY at $595. When? Well, whenever that buyer wants it. I can be assigned at any time. That is because ETFs and stock options are American style. Should do it this way. ETF and stock options are American style options. That means they can be assigned or exercised whenever the buyer wants. The seller could automatically be assigned. So you're on the hook to potentially buy stock, even if you don't want to, even if it doesn't make sense to. They can do it when it's out of the money. However, index options are European style. And what that means is there is no, sorry, there are no assignments until the expiration of the option. And the index options are cash settled. So basically, for instance, again, if I sold that put, let's say I sold the put here at 595, what happens if we end up closing below 595? Well, then I'm going to be forced to buy 100 shares of SPY at $595. Doesn't matter what the price is. Could be at 400, could be at 594.97. Okay, but I have to buy it, period. Now I can turn around and sell it immediately and take a cash loss, especially if I don't have the money for the margin required to trade it. But index options, go back to indices. There we are, SPX. And all my lines are there. Now with this one, if I sold the 59.45 put, if prices were to be below 59.45 at the expiration, because they can't assign me any earlier, it's got to be at expiration only, then I would actually have to pay the buyer whatever the difference is. So let's say we ended up expiring, this drops real quick and we expire at 59.40. I would owe the buyer $500. The difference between the 59.45 and okay, the 59.40, the strike price. The difference between those two times 100. That's all. Right. Hold on 1 second. I have to respond to a Slack message from anyway. um, yeah. So yeah, these are cash settled, which, sometimes it expires just below, and, because we collected premium, let's say as an example, give you an example of this, see how that works. Let's say we closed, because these expire at 4 p.m. on the day of expiration. But let's say we closed at 59.44.90. Okay. That means we're 10 cents in the money. That would be automatically assigned. And technically, we would have to buy at 59.45, but the value is 59.44.90. But before that happened, let's say that we actually collected when we sold this. Let's say we sold for, I don't know, let's make it easy, 40 cents or $40, basically. I'll just do it as 40 cents. There we go. So basically what happens is I collected $40. Okay, because everything is, in this case, times 100, just like it would be for stocks. So I collected $40, but because we closed at 59, 44.90. Okay, remember I sold 59.45. That means I owe 0.10 or $10. So did I actually lose? No, because I collected more premium. I'm actually still net positive $30. So I could be a loser, but still be a winner without having to exercise and buy stock and sell stock and all that other good stuff. That's pretty nice. I can just go ahead and trade, period. Oh, there goes Pascal. Anyway, so I like trading these indexes. They're cheaper typically. They're cash settled. They're European style expiration, so I don't have to worry about getting an early assignment and all that other garbage. So that's part of the reason why I like to do it. Now, a little bit further, going back to time, why do I like to do it when I do it? Well, again, some of the data from the CBOE, you can see that there's a lot of options that get traded every single day. This was actually from 2023, so it's a little bit dated, but not too much. You can see that there's a lot of people selling to open and also selling to close options pretty early in the morning. You got this 11,000 for sell to open. These are single legs. Now, the problem with selling single legs, you'll notice it's not as hugely popular. And the reason why is if you sell options, you have an extreme amount of risk. And that's not really smart. We want to limit the amount of risk that we have in our trading. Okay, we want to protect ourselves. So instead, I don't do single options. I wouldn't just sell a put. Let's put it that way. Because if I sell the put, my risk is from wherever I sell down to zero. If I sell a call, it's unlimited. So instead, I do a vertical spread, meaning I buy and sell. And you'll see that that is typically going to be much more popular. Not necessarily on the buy side. You can see vertical spreads. This is on the SPX on a time of day. Buy to open vertical spreads, 5,000, 3,000, 2,000, so on, or buy to close. But look at this net sold vertical spreads. Look at the number of difference here, 40,000 versus 5,000 at first thing in the morning. But what you'll see throughout the day, now, yes, there's a lot of people who are selling put and call spreads right at the beginning of the day. The reason why is they think that the earlier in the day, the more premium you'll collect, which is true. But is it worth it for the risk you're taking? Think about it. We are settling this based on where the market will be at 4 p.m. So at 9:30 in the morning, you are accepting a premium but you're also accepting 6.5 hours of risk, 6.5 hours of worry. Now, we saw when I talked about theta that time decay is not linear. It's exponentially increasing the closer you get to expiration. And that's kind of exaggerated on the zero DTEs because they expire that day, right? But what you'll notice if you take a look at these numbers a little bit closer is that, yes, the numbers drop from the beginning of the day, but look at this towards the end of the day. Right around 2 and 3 p.m., there's actually an increase in the number of sell to open vertical spreads. Why is that? Why are people targeting 2 to 3 p.m. to enter into new spreads? Well, if you enter at 2 p.m., how much risk do you have? 2 hours. If you enter at 3 p.m., 1 hour. I don't know about you, but 1 hour or even 2 hours of risk is a lot less than 6.5. It seems a little bit better to me. Most of the day goes by, you don't have to worry about anything. Am I going to stop down? Am I going to get assigned? Well, again, European style, you're not assigned, but am I going to win? Am I going to lose? Is price going to move? Remember that delta, that price movement really affects the pricing. But if we do it at the end of the day, it's not going to affect us as much because there's very little time left. So premium decreases into the end of the day. Yes, it does. Now, I'm not sure what GTH is. I think that's before the open, possibly. I'm not sure. But right here, look at the beginning of the day. A lot of people try to open up those trades that very, very first part of the day. Now, it gets a little bit better when there's some volatility picking up about 10 o'clock. So you can probably collect the majority of the premium for the day right around that 10 o'clock hour. But again, you're still accepting 6 hours of risk. 6 hours. And that's why you're getting more money, by the way. There's more risk. But look what happens at 2:30. We go from 370, where everything's declining down and down and down. Time decay is eroding the value of the options. But for some reason at 2:30, it spikes. It goes back up. As a matter of fact, what are we looking at here? I mean, it's percentage-wise, it's not gigantic, but it is significant. We got $482 if you opened at 9:30 in the morning, or you could on average collect $411 at the end of the day. That's a $71 difference divided by 482. You're looking at 15% difference in premiums. But what kind of risk are you accepting? Again, you're accepting 6.5 hours versus 1.5 hours at 2:30. So is that extra 15% worth it? Maybe, maybe not. I venture to say it's not worth it. And the reason why I say that is because looking at my trading, again, most of my trades are entered late in the day. I get in. This case, it was at 2:06 p.m., exit at 4 o'clock, collected a small gain. It's about consistency, building consistent gains in the markets. And that's what I was trying to show, and I didn't get to finish it. My SPX yearly tracking. I'll probably do it live with you guys real quick here. Oh, now it's not responding. What's going on? I'll take a moment. There it is. Let's see. We have, just fill it in real quick. Apologize. I should have updated this earlier, but I didn't. So deal with it. Anyway, average win. That can't be right. I think I've got to check. Yeah, I got to update this. Shoot. Let's see. Minus that one, minus I-14. That's right, too. That can't be right. That average. Let me try this again. 11, 13, then 15 to 20. Helps to know Excel. And then we have 23 to 29. There we go. Okay. I-23. I-29. That makes more sense. And then the average for losses, that's right. Okay, we're good. It didn't take long. All right. Thanks for bearing with me with that one. So the average win, 36.76. Again, that's not huge, but it's consistent. And the average loss in this case was 71.75. Yeah, let's see. The total have, that's what I wanted. Percentage wins, 80.95. 338. It was kind of a smaller month. 3.46. 16.9. There we go. But this is kind of what I wanted to show you. I started the program off in 2021, but there were only 2 months. And my average win rate in 2021 was 89%. 22 is 83%. 23, 85.96%. So went back up. And let's see, again, monthly total, average per month, total. And what do we got this year? I'm missing a couple months. That's what I was trying to get done that I didn't have time. Unfortunately, I realized this wasn't completed. I apologize, but if you'll indulge me for a moment, I can finish this. All I need is August 2024 and the numbers. There we go. 16-3. Average win and loss. Oops, wrong one. 37.19, 76. It's not really that important to finish this, but 84.21. There it goes. And it's just the last one is July. But basically, I've been doing this strategy for many, many years, as you can obviously see. And I built that consistency where I don't think I've had a losing month, period. And the reason why is the program works. I mean, I'm identifying the right opportunities at the right times. That's a key thing. There we go, 23-6. So might as well do the last one. 37.08, 117.67. And the win rate was 80% that month. Wasn't as good of a month for July, but still positive. There we go. And then we're done. So I'll close that out. And now I have the totals for the year. So slipped a little bit, and we're not done with the year yet. Actually, we've had a really good month. As a matter of fact, I'm going to show you what just happened yesterday. It's going to blow the number up quite a bit. But anyway, the main thing is consistency. And the funny thing is, you don't have to get in early in the morning to collect a decent amount of premium. Basically, the CBOE has done all these studies to see when you're seeing FOMC releases, you see when the FOMC releases their numbers at 2:00, volatility and premiums drop like a rock. Volatility is high earlier in the day. And I've got a great example of that from what happened yesterday. On no material news days, which is most days of the year, most trading days, you really don't lose a lot of premium by getting in later in the day. When there's no material news, look what happens. Yeah, there's a lot of premium in the morning, but it barely erodes. And there's still a lot of premium collectible at the end of the day, but without all the time risk. We removed a ton of that time risk. Isn't that amazing? This is, again, zero DTE decay analysis. This was more recent, actually. I just pulled this off the internet today. Option Alpha posted this one, and you can see time of day. When's all the decay coming out? Right here at 3:30. So yes, there is quite a bit of decay in premium, and this is 5 wide SPX 0 DTE. What does that mean? You're doing the strikes 5 points away, and that's what I do. I'll show you in a moment. Actually, let me skip over there real quick, show you. This was the iron condor from yesterday. It was it's hard to see. 59.35, 59.40. That's a 5 wide strike. I sold the 59.40 puts, bought the 59.35 puts. sold the 59.90 calls, bought the 59.95 calls for $1.80. And that one, I said, it kind of blew this out of the water. It actually got up to about 190, maybe 195. But selling 10 of those, and look at when the trade was opened, 2:09 p.m. yesterday. Not at the first part of the morning. By the way, in the premium wasn't even that much better that early in the morning. It's kind of crazy when you think about it. Being able to get in at a decent time. Look at my, oh, no, it's here. That's right. So basically, again, looking at the 5-wide SPX 0 DTE, 10 points out of the money, you can see that throughout the day, yes, you will collect quite a bit more premium. Well, not that much more. Again, what are these showing? Prices a little under $2. And right there at 2 o'clock, which is when I'm typically entering, it's still at $1.50. Yeah, the strikes are 5 points away from each other. So kind of showing it as a visual, if I go here, neutral, let me see, I'll just show you today. If I were to put in a spread right now, right here, I would buy the 59.80 and I would sell a strike that's 5 points above it. And I would sell a 60-10 and buy a strike 5 points above. So that's what it means, that the strikes are 5 points away. The reason why I do 5 points is the maximum risk is that spread, which is $500. But because I'm collecting premium, basically whatever premium I collect, you subtract it for $500, and that's how much risk you have. So I am typically, and this is only 10 points out of the money, I go a little bit further than that because I'm only trying to collect on average maybe 35 to 50 cents. Why do I do that? Well, look right now at this option. This has an 82% probability of profit. If I go further out of the money, and how much out of the money are we right now? We are about 15 points and 10 points on this side. So a little uneven. But if I want high probability, there's two things I can do. One, I go further out of the money. Obviously, I can also go and enter these just before the market closes, 2 hours before the close. Let's see, 80, 75. Still collect 40 cents. Probability of profit. There was no way that other one was 80 because this is lower. But anyway, I can still get decent premium and be much further away with higher probability. How else can I increase my probability? Well, not just sell based on that premium, but sell based on zones. Oh, I was on the right page there. Wasn't I? No, it was not. You'll notice what I'm looking at right here, and what I have drawn out on my chart, and if I go back, I've got years worth of data. Show you. Supply and demand zones going all the way back in time. It's August of this year, May. I mean, way, way back. I've been tracking this. Obviously, we're new highs, but I've got tricks for that too to figure out where prices are not likely to go and take advantage of that. But by selling outside of basically leftover institutional orders, that's what I do. Supply and demand, not support and resistance. That's different. But supply and demand allows me to identify higher probability opportunities. And that's all stuff that is in the program. You know, if you go into the educational videos in the SPX program, you can see SPX Cashflow Secrets right here, trading routine and finding zones. I have a whole lesson. And by the way, I'm re-recording all these lessons as we speak. I've been redoing them and editing them. So it's going to be all updated right now in the program. If you join, you'll get the new material. But basically, yeah, I teach you how to find where the institutions are trading and how to find high probability where prices are not going to go. And what happens is you learn this strategy right there, the documents, again, there's documentation that supports it all. My zoning technique, the option strategy rules, and even how to understand the text that I send out, what it is that I'm saying. And let me show you what happened yesterday. Oh, I went too far. Right there. These were the texts that went out yesterday, Thursday, November 7th. First thing, and for some reason it duplicates. I got on the list twice, so they're doubled up. But you can see at 2:04 p.m. yesterday, it just said, hey, all alerts are for educational purposes. that kind of lets you know that, hey, the texts are coming. 5-minute demand is at that price level at 9:30 and that level at 12:45. There's a press conference today. There's going to be high volatility and higher risk. It's up to you whether or not you want to trade that. Look at this, 2:09 p.m., 59.35, 59.40, 59.90, 59.95 iron condor is currently $1.85 and 78% probability of profit. Pretty good odds, right? Remember, I'm selling not just outside of a certain range with the probability of profit, but also I actually have higher probability of profit than what that's showing because of my zones. Okay. Absolutely, Jennifer. If you want to email me, I can get you some information on the subscriptions. Yeah, I do 2 different subscriptions, by the way. I do quarterly and I do a monthly subscription for the program. And we'll get the link back up there again. We had it before. Yes, I will be posting videos for review. These will be posted on our YouTube channel, the videos that I do typically. Anyway, so there was the first trade idea that was posted at 2:09 to collect $1.85. And then there was a second chance at about 3 o'clock, only 1 hour's worth of risk, right? And you can see there was another iron condor selling 59.30, 59.35, a 5 wide spread. I keep it under $500 of risk. You could literally trade this type of program for $1,000 in your account, depending on the brokerage you're with. Okay, I wouldn't do it just $500 because that's the maximum risk. And if you lose, you can see whatever margin you come up with. For instance, here, again, if I look at, what is this, September's? For instance, here's an iron condor. Okay, 9.5, we had an iron condor, 35 cents collected. The margin and maximum risk is $465. We got in just before 2 p.m. It ended up being a winner. It expired worthless. You'll notice, though, sometimes they don't work out. There's a loss. And I actually have rules for how to set up the stop losses. I even have videos on different brokerages for that. Going back over to the program right here, trading using Tastyworks, trading using Thinkorswim, and setting TradeStation stop losses based on strike price. So how to trade those strategies and set up the spreads the way that you need to with the stop losses. But if for whatever reason the stop loss gets triggered, I usually send out a text message as well. For instance, here at almost 3 o'clock, I put out the second trade opportunity for those people who wanted to take a little less risk, because this is just after the news came out for the Fed. Here, this was way after the press conference, less risk. Notice what happened about 30 minutes later. All of a sudden, this dropped low enough you could close out the position, not even wait till the end of the day if you wanted to, or hold to the end of the day. And the same thing at 3:35, you could have closed out the bigger one, 185, for a profit of 44% rate of return. By the end of the day, everything expired, got to keep 100% of the premium if you chose to. So that's pretty cool, but that's what I do every single day. I've been doing this for, like 10, 15 years, but these are the actual screenshots. You can see I take a screenshot of every trade before and after it's received on my phone. So that way I've got proof that was actually available, that pricing. And then I take a lot of the trades as well. Of course, I'm not stupid. But yes, you can trade that way on pretty much any platform. Oh, I was looking for the toss. There it is. So if I wanted to, I can go into toss. And for today, I typically do iron condors, which is 2 vertical spreads. I collect more premium without having to come up with any more margin, which is kind of nice. So I'm on the wrong security. Again, I want to do SPX, not SPY, because they're European style. The costs are lower. Now, I haven't done all my analysis yet for the trends, but let's just say, hypothetically, I was looking at about, 59.75 to 60.15. Okay, go right here. Let's say 75. There we go. So I want to sell. That was the wrong one. Delete. Oh, no, that's right. The puts. Yeah, I did it wrong. That's okay. So calls. There we go. Buy 60.20. Sell 60.15. That's the bear call spread. And the bull put spread, I was looking at doing 75 59.75, 59.70. There we go. And that's actually a 50-cent credit right now. What does that mean? Well, if I sold that, I would collect 50 cents or $50 per contract. I would only have to come up with $450. Now, what is my actual risk? $450. That's the most I could lose. If this thing just slammed down below my options or went up way above the strikes, I could lose no more than $450, period. But in reality, I'm not going to let it go that bad. I'm going to get out if prices break my zones or if we lose a certain amount of premium. And those are all rules that are set forth in the program. Like I said, there's videos you can watch. There's Q&A sessions where we get together. As a matter of fact, I'm very available for my students. Even on the program right here, you should be getting the SMS text messages on a regular basis. And you can see right here. I don't think I had any stopped out recently. No. But at the very bottom right here, you can send me a message if you ever run into any problems or questions. Additionally, if you have any questions about anything I talked about or you're interested in joining the program, as I mentioned before, if you go to the link, where was it here? I just saw it. There it is, SPX Cashflow Secrets. As I mentioned before, I do 2 subscriptions where you can either do it as monthly or quarterly. The quarterly, obviously, it's cheaper. There's also a free 2-week trial with the quarterly. You can do it for no risk. You sign up, and the first 2 weeks, there's no charge on your card. I think it even says it right here. If you click on it, it says, oops, quarterly. There it is. Right there. And yep, 0. So you will not get charged for the first 2 weeks. After the 14-day free trial, you'll get charged the $6.95 for every 3 months, which is what, about a little over $200 per month. And the return's pretty good. If you have questions, support at wealthbuildershq.com is the email address to reach us. Oh, I sent that to hosts and panelists. Meant to send it to everyone. So first of all, there's the link and then the email address. There you go. So the questions that you guys had, I think it was a question that Jennifer had and also that Paul had. Yes, email us and I'll go ahead and take care of that for you. But yeah, if anybody has any questions about 0DTE, like I said, the main thing we got to be careful of is prices. And the way I increase my probability and lower my risk is by using trend, supply, and demand to identify where prices are not likely to go. I don't have to worry as much about volatility because, again, the Vega's very, very minimal when it comes to the 0DTE versus long-term. But I just got to make sure I find the right opportunities. I've been doing this for a long, long time, as I mentioned, over 10 years for this particular strategy. And I think I got it to where it works very, very well. And the numbers, the proof, really is what it comes down to. We're getting that consistent return, even though the losses are much, much bigger than the wins. The other nice thing about this is, if you'll notice, even when I went into a streak of losers, I never violated pattern day trading. If you buy into or sell these options on an index and they expire worthless, that doesn't count for pattern day trading. You do not need $25,000 in your trading account. It's only a day trade if you're stopped out. And even if I have a bad month, which I've had, where was it here? Actually, October was decent. It was above the cost of the subscription. That's the main thing. But you can see that I had a loss. I had a loss. That's only 2 within a 5-day rolling period. I had another 2 losses, but never had the others after that. That one actually would have been a winner had we not stopped out, unfortunately, but it's a loss. But I've never had more than 2 within a 5-day period, so we never even violated the pattern day trading rules. That means you could get started trading this particular strategy for as little as $1,000, $2,000 with some brokers, only $1,000 with others. Technically, you only need $500, but you want a buffer. You don't want to have that razor thin margin there. It's not smart. So again, if there's any questions, please let me know. I want to thank everybody for being here and giving me some of your time. And thank you. Happy Veterans Day to everyone as well. Have a great weekend. Trade safe, trade well, everyone. Hopefully I'll see you in the SPX Cashflow Secrets program. So if you have any questions, of course, you got our email and let us know.